A variance swap is a financial contract that allows investors to trade the volatility of an underlying asset, without actually taking a position on the asset's direction. In other words, a Varswap is a way to bet on how much the price of an asset will fluctuate over a certain period of time, without actually buying or selling the asset itself. A Varswap involves two parties, the buyer and the seller. The buyer of a Varswap pays a premium to the seller, and in exchange, receives the realized variance of the underlying asset over a specific time period. The realized variance is calculated as the average squared difference between the daily returns of the asset and its expected return over the specified time period. If the realized variance of the underlying asset is higher than the strike variance, the predetermined variance agreed upon when the contract is established, the buyer of the Varswap receives a payout from the seller. If the realized variance is lower than the strike variance, the buyer pays the seller the difference. Varswaps can be used by investors to hedge against volatility risk, or to take speculative positions on the expected volatility of an underlying asset. They are often used in quantitative trading strategies, such as volatility arbitrage and volatility trading, by hedge funds and other institutional investors.